Hello friends, we are going to continue with redemption of debentures, and we have done two very important topics, that is DRR and DRI. Right, we discussed about DRR and DRI. This is debenture redemption reserve and debenture redemption investment. Right, DRR and DRI. The main purpose of creating DRR and DRI is to secure the payments to debenture holders and to avoid making payment through capital. Right? This is what we discussed. And payment to debenture holders is an obligation for the company. Right? So DRR is to be created at the rate of minimum 25%. 25% of what? Of face value of debentures issued. And what about DRI? DRI, it is to be minimum 15% of face value of debentures to be redeemed on 31st of next year. Clear? So this is about DRR and DRI. DRI is to be created at the rate of minimum 15% of face value of debentures to be redeemed on 31st of next year, and it is to be created on or before 30th of April of this year. Right? And DRI, the companies which are exempted from creating DRR are also exempted from creating DRI. Clear? So this is all what we discussed about DRR and DRI. Now what we are going to discuss is methods of redemption of debentures. Going to start with methods of redemption of debentures. Right? We have basically four methods in this. Number one is lump sum payment on redemption. Second is by draw of lots. Right? Third is by purchase from open market, and the last one is by conversion. Right? So these are the four methods by which we can effect redemption of debentures. Right? The first is lump sum payment. Second is by draw of lots. Third is by purchase from open market. And the last one is by conversion. Right? So now first we will be starting with redemption of debentures on maturity in lump sum. The first one we will do is redemption on maturity in lump sum. Right? It says that on 1st April 2016 you issued debentures for rupees 1 lakh rupees. Right? And at the time you decided, at this time only, the time of redemption is decided. Right? They say these debentures are redeemable after 2 years, that is 31/3/2018. So this date is the maturity date. The date on which the debentures are to be redeemed. This is known as maturity date. Now on this date, we know we have to pay 1 lakh rupees. So this is redemption on maturity in lump sum. That is, on the maturity date, we are paying the debentures in lump sum. We might pay them at par or at premium, right? Always remember one thing, redemption can be in two forms only, either at par or at premium. Clear? Either the redemption will be at par or at premium. Now let's see the journal entries in this case, redemption on maturity in lump sum, right? Let's see the journal entries. Right? So the journal entries will be, first, amount due to debenture holders, right? This will be, say, 10% debentures, 10% debentures account debit to debenture holders account. Why debenture holders account? Because debenture holders become our creditors. It becomes the liability. So debenture holders will be credited and 10% debentures will be debited. Right? Then, so when you are making the payment now, on payment, what will be the entry? We are paying our creditors, that is debenture holders, account debit to bank account, right? This is the journal entry on payment to debenture holders. This is the payment being made on maturity in lump sum. Clear? This is the case when redemption is at par. Now let's see when redemption is at premium. At premium, in this case, what is going to be the entry? First of all, we have to identify the amount due. What is amount due? 10% debentures account debit. Here we will take face value. Then we are paying premium. We have to pay premium. Redemption is at premium to the debenture holders. Here the face value is 100, say. Then we'll say premium on redemption of debentures account debit 5 rupees. What is the premium? 5 rupees, right? To debenture holders. So to the debenture holders, we have to pay the face value of 100 plus the premium of 5 rupees, a total of 105 rupees. Clear? So for the premium, we will debit a separate account that is known as premium on redemption of debentures account. Clear? Clear, friends? And when this payment is made, then debenture holders account debit to bank account 105. Clear? So if the payment is at par, then debentures to debenture holders and debenture holders to bank. If the redemption is at premium, Then we have to pay the face value plus the amount of premium on redemption. For that we say 10% debentures account debit, premium on redemption of debentures account debit to debenture holders. Simple. Then debenture holders to bank 105 rupees. Clear, friends? Right? So these are the journal entries for redemption of debentures on maturity in lump sum. Right? Now quickly see what will be the journal entries that you will have to pass. The first entry will be for issue of debentures. Right? Issue of debentures is bank account debit. You will receive application to debenture application account. Then this debenture application will be transferred to debentures account on allotment account debit to say 10% debentures account. Right? This is issue of debentures. Then what you have to do? The next you have to create DRR. For DRR, the journal entry is surplus account debit to DRR account. Right? DRR is created out of profits. So surplus account debit to DRR account, we have created DRR. Right? Then before redemption of the debentures, we have to invest in specified securities also. That is DRI. For DRI, it will be investments account debit to bank account. Right? This is on or before 30th April. Isn't it? Right? You have made the investments now. Now when the time of redemption comes, what will you do? You will encash these investments or keep these investments for further use. Suppose you are encashing investments. Encashing investments, then bank account debit to investments account. Right? Clear? Here you have encashed your investments. First you invested in the specified securities, you made the investments, now you have encashed your investments at the time of redemption, just before the redemption, right? Then there will be entries for redemption. Redemption of debentures, that will be say 10% debentures account debit to debenture holders. First the amount is due, right? Then debenture holders account debit to bank account. Right? These are the entries for the redemption of debentures that we just discussed. Right? If it is at a premium, then we will deal accordingly. Okay. Then the final will be transfer of DRR to general reserve. So if you have any balance left in the DRR, that balance will be transferred to general reserve, DRR account debit to general reserve account. Clear? So basically these are the entries that you have to pass at the time of redemption of debentures. First, for the issue of debentures, right? After issue and before redemption, you have to create DRR at the rate of minimum 25% of face value. Then what you have to do? You have to invest in the specified securities, that is known as debenture redemption reserve. This is to be at the rate of minimum 15% of face value. Right? Here it is 25% of face value of the debentures issued. Here it is 15% of face value of the debentures to be redeemed. Right? The basic difference between these two. For that, investment to bank. Then just before the redemption, you are encashing your investments. For that, you will say bank account debit to investment account. Right? Then you will pass the entries for redemption of debentures that we have just discussed, and then if there is any balance left in the debenture redemption reserve, that balance will be transferred to general reserve. Clear? So you can write this down. These are the basic entries that we have to pass at the time of redemption of debentures. Clear? So we have done redemption on maturity in lump sum. Clear, friends? So if you have any queries, just send me an email at ksjteaching @gmail.com, right? And in the next lecture, we are going to do some practical problems on this. Practical problems on redemption of debentures in lump sum. Right? So in the next lecture, we'll do some practical problems. Then we will move on to the next method. Right? So that's all for this lecture, friends. Thank you so much.